So let's take a look at, real quick, my ES positions, MES positions. I got a lot of stuff going on at ES, MES, right? Got this put debit spread, way out of the money, put debit spread in ES, which I bought for $1. Max profit on it's $2,400 to the downside. Got long puts that expire today. These were hedges that were on. Put these on 95 days ago. They're just now expiring today. Long put hedges. These are calls that I bought yesterday for like a weekly trade. Put these on a Friday, take these off on the next Friday, put the next one on. It's kind of a forever, just be long, the ES kind of trade, or the MES here. Slightly profitable on these. We're having a down day today. And then put debit spreads, downside, hedges. Then I've got a standard put ratio spread, a front ratio spread that I'm almost at 50% max profit on, not quite. And then I've got a back ratio spread that is interesting because that's more of a downside hedge. I've got 3 short puts, and then further, way out of the money, some long puts, 5 long puts. And the way I'm treating this is if I eventually get to 75% max profit on the 3 shorts, I'll close it, and that should pay for the 5 longs that I would just leave on for downside protection, which is kind of what happened with some of this stuff. Like these long puts, well, you can see this long put here was actually part of a vertical spread at some point where the thing became practically worthless. All the options were practically worthless, so I just got out of the short put and left the long put on by itself. Eventually, that's what I need to happen here. I need these 3 short puts to lose at least 75% of their value, and then that would cover the price of the longs. And then I've got short puts here, these 2 short puts that I sold for potentially a $440 credit max profit. If I eventually take these off for 50% max profit, then that $100 debit that I paid for this will be covered by that, plus I'll profit another $140, $150 that I can just pocket. So a lot of this, I'm using some of these options for financing other trades, right? I want to buy hedges, but I don't want to pay for the hedges. So some of these short puts are financing some of the long puts. Some of the short puts are financing the put debit spreads. You wanted to do downside put butterflies, sell a put to finance it, which is something you certainly could do if I wanted to sell one of my standard trades. A lot of times I go about 90 DTE and sell somewhere between a 7 and 10 delta short put. Kind of a normal trade, right? In this example, let's do the 7 delta put at 98 DTE. Receive 30 credit times 5. This is the ES, so this would be $1,500. Now, what if I wanted to spend some of that $1,500 for a downside trade? Maybe I wanted to do a butterfly. Let's do a really cheap kind of butterfly spread. How about I buy the 12 delta put, go $200 wide, then another $200 wide. Let's double up the shorts. This butterfly spread I pay $200 for, max profit $9,800. I have to make up the $200 though. Well, we already saw that I could sell a put. Let's sell the 6 delta just to get slightly below the butterfly. And now I'm overall making a $22 credit times $50,000 credit. More than makes up for the butterfly. And let's check the analysis on this. Now, this is some of the interesting stuff you can do with these trades is you got to start thinking more of how your overall portfolio looks with some of this stuff. Well, this is the butterfly with the additional short put that paid for it. So typically, a butterfly spread, turn off the additional short put, looks like this. You got this profit area, and then you've got your wings on the outside where you've defined your risk, but you lose on both sides. Well, because of the credit I receive on the additional short put, now I can't lose to the upside. Right, I win to the upside because the credit more than makes up for the loss on the butterfly on the upside. And, I can't really lose to the downside until I get below the put. So, gives you a little bit of runway here. But the point is, I financed this debit trade because the butterfly was a debit trade. I used a credit trade to finance it. And that's kind of what I'm doing with some of those other trades that you saw. Right, I've got debit spreads that I finance with short puts. I've got long puts that I financed with short puts. And And depending on buying power, sometimes you can put these trades on for no additional buying power. Sometimes you can put these trades on and it actually frees up buying power. Right now, I have 2 naked puts, 3 more naked puts, 2 more naked puts, part of these ratio spreads. So total, I've got 7 naked puts in MES right now. And I've got a little bit of downside protection, but not much. I also have the 2 long calls. So I got a lot of bullish stuff on. Like, this is really a bullish position. If I wanted to go put on a bearish position today, I can probably go sell some calls and they wouldn't charge me any buying power at all. Let's actually do that. Let's say we'll keep it a shorter dated trade. Maybe I just want to hedge a little bit for the next 30 days. What would a 12 delta call look like? Buying power reduction, no buying power reduction. 55-cent credit, right? That's a free trade. If I wanted to take that, I certainly could. It's not a risky trade necessarily, even though I'm selling a naked call in MES. Well, what if MES goes up? Well, what if MES does go up? I'm going to lose on my call. Yeah, I'm going to lose on my call. But did you see how many short puts and long calls I had? I had 7 short puts and 2 long calls. I'm going to make a killing, especially on the long calls, because just their very nature, they have unlimited upside potential. You know, I'm never going to be in a situation just selling this 1 call anyway, where I'm really going to be hurt. Really, I could sell 3 or 4 calls, and I'd probably be in a perfectly fine situation where, you know, the upside, I'm never really that worried, not with my portfolio. The downside, of course, we actually win on the calls. I get murdered on all the puts, but hey, that's fine. You know, that's the risk I'm taking there all the time anyway. But it's really nice having trades in your portfolio, having some bullish, some bearish, some neutral, having some trades that are defined risk, because I've got some credit spreads, I've got some debit spreads, I've got some long calls, all defined risk. I've got some trades that have a limited profit potential, some that have unlimited profit potential. I've got some trades that are negative Vega trades. I've got some trades that are positive Vega trades. So the short options are all negative Vega. If Vega goes up, volatility explodes, I get murdered, right? But things like long puts, some of those hedges, like in that back ratio spread, right? Those things are greatly helped by a volatility spike. So you need to have a little bit of everything in your portfolio just for diversification and just to be safe. And plus, it gives you a chance to profit at different points of time. Regardless of what the market is doing, you've got some things that should be working for you a little bit. Ultimately, the worst thing, you know, when you see people blow up their accounts, what are they doing wrong? Well, they're doing 1 trade, 1 strategy, and that's all they're in. All they're doing is selling naked puts in the ES or the NQ or SPY, whatever, you know, one of the index products. They're just selling naked puts, and that's all they're doing. And when the market eventually crashes, and the market every few years is going to see a 20% correction, 25% correction, you know, we had one this year, right? And if you go back to COVID, you know, that thing was like 30% down at one point for the year. You know, and if all you're doing is selling short puts, you know, you're setting yourself up to really blow up your account. And even define risk trades, if all you're doing is selling nothing but put credit spreads in SPY or QQQ or whatever, that's the only trade you're making. Well, eventually you're going to have to size up to make those things worth it. And again, the 20-30% correction, especially on defined risk trades, because you can't really roll those things. You know, you're just going to get bent over, right? You don't put yourself in that situation. So have a little bit of hedging going, but basically play both sides of the market if you can. Matter of fact, let's actually do something, since I'm sitting here mentioning that we should play both sides of the market. I'll go ahead and put on a trade here. What I'm going to do, the 34-day calls are just not juicy enough. Kind of like I go 90 days for my short puts, I'll go about 90 days for my short calls. Let's go 77 days. And, you know, go about 10 deltas maybe. 10 delta, or in this case 11 delta call, only going to give me an $83 credit. To make this worth it, I need to sell at least a couple of them. $167. No buying power because I'm already short the puts. I'm already using a ton of buying power on the put side. You can't lose both on the put side and the call side. I can put these trades on for free. So I can sell these 2 calls, no problem. One thing I could do a ratio spread. A 2-by-1 ratio spread is going to cut the profitability of this in half, because now no longer am I naked 2 calls. I'm only naked 1 call again. The 1 call was not enough for profit, but I could do a 3-by-1 ratio spread. Now I'm still short the 2 calls. Plus I've got the call debit spread as an upside kicker, if you will. Anyway, I get a $30 credit times 5. So I get a $150 credit for this trade. $150 would be my max profit potential to the downside. My max profit in the spread itself is 276. You know, if I was lucky to hit that. Buying power reduction, again, no buying power reduction. I get a $150 credit, no buying power reduction. And I hedge a little bit, right? I get some short deltas instead of all those long deltas that I've got in this portfolio right now. Put that on, because why not? Why not take essentially a free trade? It's not a free trade in terms of, it's kind of a free trade in terms of buying power, but it's not a risk-free trade, right? I could definitely lose on the trade. I'm going to let that sit and work. Right now, the market's moving around a little bit, but that'll probably get triggered here in a minute. It's definitely not a risk-free trade, right? I could lose on it. But the thing is, if I lose on this trade, I'm more than making up for it on all the long positions because I'm so long ES right now. Plus, I've got so many short puts. I don't necessarily have to realize a loss on this ratio spread should it go against me. Should this go against me, I've got 2 naked calls that I have to worry about. Well, the 2 naked calls, I could probably roll out in time, and then some of the short puts that will be way more than 50% winners if the call ratio spread's going against me. I can use some of those naked puts that are already winners, roll them with the 2 calls into a new strangle further out in time, adjust the strikes. You know, it's a very safe trade, that call ratio spread, just because of everything else I already have on. Now, if you're thinking of the trade by itself, you're thinking, well, that's a very risky trade. You just sold 2 naked calls in the MES, you know, a product that tends to just go up over time. Yeah, I would never put that trade on by itself. But in the overall grand scheme of things, it just makes sense. And again, I didn't have to put up any money for that trade. And you got to start thinking about these things not as the one trade. Let's take a look at the risk profile on all these trades, on all of these ES, MES positions. Well, this P&L graph is all the ES and MES positions, right? So short puts, long calls, call ratio spreads, put debit spreads, you know. But again, this is just not random. You know, it's not like I put on all these random strategies and didn't know what I was doing. You know, I constructed this in such a way. I want to be long the market, and I am, but I don't want to be so long the market in a reckless way where if the market goes down, I get murdered on the way down, right? Don't get murdered here, right? Lose a little bit. You know, 10% move shouldn't hurt too bad. It'll hurt, but it shouldn't hurt too bad. Again, it's not entirely reflective of what the market, of what my portfolio will look like, because this is again a T0 line. If it moves this second, also doesn't take volatility into account. Volatility greatly affects these positions. But again, this just gives you some basic idea of what your risk is right now, this P&L graph. And this is this button here on Tasty to P&L, and you can turn on and off positions. Again, this was just the ES, MES positions. But if you're not familiar with some of the risk analysis tools here in Tasty, what you can do, go to this button here, cap requirement, which you've probably seen me use this before, and it's kind of neat. If you go to allocation, you can actually get a visual representation of all your positions, right? You got stocks, your equity options, your futures options. If you got any index options, they'll be down here. Typically, they'll be like red or pink. Right now, the only index option I have is the one small little VIX trade, so it doesn't even show up on the graph. But what I want to show today is the risk analysis tool. So go to cap requirement, and if I wanted to analyze all my ES, MES positions, ES doesn't show up here. One thing with Tasty, if you got things going on in both ES and MES, typically they group it all as one group, which makes sense. Same thing with the allocation. You see futures, ES is here, MES is nice, just all those positions are right there. So cap requirement. Let's turn on all of the ES/MES positions and do a quick risk analysis. So using this tool, what you want to do is you want to go here to where it says none, turn this to beta weighted. Now, we're only using ES right now, which, is the SPY. Beta weighting it doesn't really matter. But if you were analyzing other things, so if you're analyzing your ES positions along with all your other positions, like you got positions in Google or Microsoft or Meta or whatever it happens to be, beta weight it all. Otherwise, the numbers get kind of wonky. And then let's imagine that, SPY goes up or down 20%. What this table is we go down 4%, 8, 12, 16, 20, or we go up 4, 8, 12, 16, 20%. Beta weighting to SPY, obviously. IV shift, this is very important if you're primarily short options. What happens to IV, especially if the market is going down 20%, because that's really what we're focused on here. If we get a 20% down move, IV going to go up at least 30%, right? What I'm thinking. So IV typically hangs out in the upper teens, lower 20s. It's going to be in the 50s. Let's go ahead and bump up IV to 30. And this is what we would be staring at just on the ES, MES positions. We'd be down $9,300 if we went down 20% and IV went up 30%. But this chart would allow me to actually turn off some stuff. Remember the 5x3 back ratio spread? Now let's turn off the 3 short puts. Let's imagine they came off as winners. So now I have 5 long puts of additional downside protection. Now what happens on a 20% down move plus a vol spike? Vol spikes help long puts, by the way. So that's greatly offsets. Now I'm not really losing at all. If I were able to take that back ratio spread to the point where the shorts could come off and I can leave the longs on for essentially free, hell, we're looking good there. You can imagine if I had a couple of those back ratio spreads on that I was, able to take off all the shorts at some point. Let's say I had 10 long puts, then I'm actually up money on a down move. So that's the thing. I'm just trying to, do some of this analysis where I don't want to get blowed out on a down move, right? And to be honest, even with the short puts, the way my portfolio is right now, I would say I'd be fine, but I'd survive a 20% down move. Hell, I did it in February, right? It wasn't that big of a deal. I'm back up on the year, right? So, but if you haven't ever analyzed your portfolio, you really should, because one of the things, especially with new traders that don't think about their overall portfolio, they just think about individual positions, and sometimes your overall portfolio, which is all one position. Have you really analyzed that thing? What happens if the market goes down 20% and IV goes up 30%? If you're using the Tasty platform, you should actually go check that out right now. I think some of you would be a little shocked what would happen. Is there a way to see how a new position would affect the overall portfolio? Absolutely. Yeah, absolutely. I'm glad you mentioned that, because risk analysis. So here's what we do. Since we're analyzing the ES, MES positions, let's put on a potential new trade in MES. Or actually, to make it clear that it really affects us, let's do a bigger contract. Let's go to ES. What would a 30-day in Delta put do to our risk analysis? Now, this is a working order. I don't have to send this. It's just a potential working order, but I still want to see how this affects risk analysis. Let me go to the risk analysis. So cap requirement, go to cap requirement, make sure everything is turned on, including the potential new trade. So if I go to risk analysis and go to order legs, so add order legs from order entry. So this will add the working orders, and not working, but potential orders. And now you see it changed. Now I get the additional short put. Now, how did that change my risk profile? Well, instead of losing $9,300 on a 20% down move, I'm losing $52,000. The ES, 10 times the size of the MES, right? Added a ton of risk. So there you have it. Just hit order legs to add that potential. You will often do this, like when you're trying to construct a hedge, like, hey, I've got $52,000 of risk to the downside. How would I hedge that? Well, go add a long put in ES. Go add some long calls in VIX, or whatever it is you're doing. Go add those and then come back to the risk analysis. Hit order legs, and now you'll see how that affects you. In this case, that was obviously not a hedge. That was actually adding a ton more risk. If I turn that back off, you can see went from basically down 10,000 to down 50,000. Now, also, if you add the new order, the potential order, and you're like, that's not what I want, you can always get rid of it. So hit the X order legs, remove it. The plus order legs adds it.